Hello, my name is Sarah Kummer. I am an accounting student in Bill Reed's 203 accounting class, and I'm here to chat with you about the statement of cash flows. Today is May 23rd, 2019. All right, how many of you in this room have utilized the envelope method of budgeting? Dave Ramsey, anybody? Basically what you do is you put cash into an envelope every set amount of time that you have budgeted for a specific expense. Let's say gas for a week. And when your gas money is out, you quit buying gas until you're able to replenish it. Many of you might think of the way our cash works here at work the same way, like physical cash. That is not how we measure cash. Instead, we use a report called the Statement of Cash Flows. Did I just become the teacher from the Peanuts comics? Stay with me here, I'll keep it simple. And there might even be a participation prize in the end, or not. You'll have to participate to find out. What activities are bringing cash into the business? What activities are pulling cash out of the business? How much cash is left at the end of every month? Each month, our accountants prepare a report called the Statement of Cash Flows to answer these questions and more about the liquidity of our business. Without them, we would have to prepare these ourselves. And speaking for myself, I would hate that. So can we all just take a moment to thank the accountants? All right, let's talk about what the definition of the Statement of Cash Flows is. Oh, this is where I really become the teacher from the Peanuts. The Statement of Cash Flows, or the Cash Flow Statement, is a financial statement that summarizes the amount of cash and cash equivalents entering or leaving a company. I have provided you all with a copy of our most recent Statement of Cash Flows to follow along. A fun fact about the Statement of Cash Flows, or maybe a not so fun fact, is that while the income statement and the balance sheet have been around for a long time, the Statement of Cash Flows has only been required in the United States since 1988, so it is the baby of our reports. It's broken down into 3 sections, so go ahead and grab your copy and follow along. Section number 1, operations, operating. Investments is section number 2, and section number 3 is financing. Operations are the cash that we spend and receive to provide our products and services. Investments is the amount of cash that we spend or receive relating to our building and our vans, some of the other things that we use, even the tables, the whiteboard, those are all investments. And then financing, it's easy to get financing and investments confused. Financing is actually the money that we receive for financial investments that we hold, like bonds. If we have a bond that pays out an interest every month, that would be cash we would receive from financing. Or it is also the payments we make on debt. That all falls into financing. So what we do is we add all of these up, and it will either be a positive or a negative number. And then we add or subtract that final number to whatever we began with. So whatever was already in the bank account or on that registry, that check registry, at the beginning of the month is then added or subtracted to the final number from this month's cash flows. It all starts with income. So who here can tell me why income does not equal cash? I gave you a hint 5 seconds ago. That's right. Income includes accounts payable or debt and accounts receivable, future cash that we have not received yet. Remember, cash flow does not measure income. It measures the flow of cash or cash equivalents coming into and leaving our company. I pulled a quick explanation from this website that I think will really help you to follow along and understand. It all starts with earnings. It's a great word, right? We all like earnings, whether it's personal or professional. Under earnings, well, where do we get our money from? Anybody? Sales, that's right. Revenue for our products and services. So let's say that every month we sell $100, just to keep it simple. Now, what comes out of this? Well, expenses are the next line. And let's say our expenses are $60. That gives you your income or profit, which is $40. But we all know, everyone in here knows, that when we sell our revenue, when we incur revenue every month, we don't receive it right away. The customer doesn't come to us and say, thank you so much for installing that lighting for me. Here's your $100. Instead, it goes into accounts receivable. So let's say that this month we were able to collect $30 of the $100 that we earned for providing services and products. And then next month, we are going to collect the other 70. Now, furthermore, let's say this month we had to pay $30 for our expenses, and the rest of them went into accounts payable for next month. $30. Now, the difference is we had zero cash at the end of this period, which would be bad. But at the end of next period, we had how much? Who here is good at math? Kidding, it's a really easy math problem. 40. And at the end of it all, really the cash somehow will often equal our income minus the value of our capital. So why does this matter to you? Remember, the cash flows only care about cash or cash equivalents received and dispersed. Liken it to a checkbook registry. At the end of the registry, we enter in every activity, right, when we're balancing our checkbooks, and we do not do that with the statement of cash flows. It's broken down into groups, but the end result is the same. We know how much cash we have. With the salespeople in the room, this is why we encourage you to negotiate net 30 payment terms, because the faster you can bring that cash into the business, the healthier our cash line is. Now, if you're a business unit manager and you need to manage your cash flow for your business unit, remember it's broken down into 3 sections: operations, investments, and financing. So when you're reviewing it, you can look for areas where you're realizing a strong inflow of cash, somewhere where maybe your business is very healthy. And you can also look for areas of improvement where maybe you're losing more cash or spending more cash than you should be for any fiscal period. This will allow you to control your cash in better ways. Now you're all set. Any questions?